What is a bank? A bank is a financial institution that is licensed to accept checking and savings deposits and make loans. Banks also provide related services such as individual retirement accounts, IRAs, certificates of deposit, CDs, currency exchange, and safe deposit boxes. There are several types of banks, including retail banks, commercial or corporate banks, and investment banks. Understanding banks. In turn, the banks use the cash that is deposited to make loans and collect interest on them. The basic business plan hasn't changed much since the Medici family started dabbling in banking during the Renaissance, but the range of products that banks offer has grown. When you deposit money to the bank, they will hold 10% of it, then loan out the rest to businesses or a large corporation with a large amount of interest attached to your loan. They use a method like fractional reserve banking, but banks also have to think about profitability, the interest they charge, costs of running the bank, and losses they may face if a borrower does not or is unable to repay the loan. Another limit is capital requirements, the amount of capital a bank must hold relative to its total lending. The bank lends the money out in car loans, credit cards, mortgages, and business loans. The loan recipients spend the money they borrow. The bank earns interest on the loans, and the process keeps money moving through the system. Just like any other business, the goal of a bank is to earn a profit for its owners. For most banks, the owners are their shareholders. Banks do this by charging more interest on the loans and other debt they issue to borrowers than they pay to people who use their savings vehicles. For example, a bank may pay 1% interest on savings accounts and charge 6% interest for its mortgage loans, earning a gross profit of 5% for its owners. Banks make a profit by charging more interest for loans than they pay on savings accounts. They can print as much money as they want, though there are consequences for doing so. Merely printing more money doesn't affect the economic output or production levels, so the money itself becomes less valuable. Since this can cause inflation, simply printing more money isn't the first choice of central banks. Unlike the banks above, central banks do not deal directly with the public. A central bank is an independent institution authorized by a government to oversee the nation's money supply and its monetary policy. As such, central banks are responsible for the stability of the currency and of the economic system as a whole. They also have a role in regulating the capital and reserve requirements of the nation's banks.